Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
We begin with our top story, another hotter than expected inflation print, pushing out rate cut bets ahead of next week's Fed decision. Jon Stoltzfus of Oppenheimer still expecting the end of free money to come to a close. Quote, for those of us who began our careers when 10-year Treasury yields, corporate yields and mortgage rates were at double-digit levels, the phrase none of me thanks, or none for me thanks, comes readily to mind should the Fed cut rates too early. I'm pleased to say that Jon joins us now. Jon, we talked about the scent of stagflation. Do you smell the scent of stagflation?
I think it's a little too early to call that, John. I think a couple of hot numbers in terms of hotter than expected numbers in terms of inflation in the process of a Fed funds hike cycle that has been remarkably sensitive to its effects on the economy. Just tells us this is part of the bumpiness you get coming out of where we have been, going into a sustainable economic recovery at moderate pace with what is the equivalent of full employment, 3 to 4% unemployment.
There is one takeaway, though, from some of the price action, John, and it's that all the hopes and dreams of a broadening out in the rally seem to die when we have the idea of rate hikes delayed, deferred, or put off indefinitely. Really, that has been the takeaway for me, is that this week when people were worried about fewer rate cuts or even no rate cuts, you saw the equal weight underperform dramatically, the S&P 500. Do you take away something about that in terms of how vulnerable that trade is?
Too short a period to take away, and think that this vulnerability does not exist. It certainly does exist, but at the same time, we're headed in the right direction from what we can tell. And you've got just extraordinary times when it comes to innovation. The resilience that's seen by business in the latest earnings season for the S&P 500 with earnings up close, just under 8%, revenue growth up about 4%, sorry. And with that, 4 sectors, double-digit earnings growth, and not all tech. Things are good. It's just that they're not as great as people would like to see. We're not there yet. We're in the car, but are we there yet? Not yet.
Okay, so but you're waiting for the there to happen. You're not waiting for the stagflation to happen. And I guess what's the line between the two? Because ultimately, what we did see yesterday, our minds have to kind of go to the stagflation point. Like John was mentioning, given the fact that we saw inflation come in hotter than expected, retail sales come in lighter than expected. When do we start to get some sort of definitive read on which it is? Is it the strength or is it the slowdown?
It probably comes from a combination of both. It's a combination of the resilience with the slowing, because you've got the Fed, the last 2 years hasn't been on holiday. It's been involved, bringing down the rate of inflation. But inflation is an insidious thing. The other thing I think that we're waiting to see, and it's beginning to happen in food, we've seen it in some aspects in clothing, not really yet in rents, but is competition. Competition, when you go into inflation, originally those who experience high input costs, they eat the inflation and don't pass it on. Then once everybody knows inflation has reared its ugly head, they pass it on to their customers. And then once the Fed does what it's supposed to do and begins to have some significant success, then suddenly those that originally ate the inflation then passed it on, hold on to passing it on for a bit longer so they can make up for the losses at the beginning of the cycle. And then somebody says, hey, you know what, I think I can sacrifice my unit price and maybe make it up in volume. And that is what we're waiting to see. And right now, I think it's a good thing that the consumer, based on those consumer sentiment indices, shows that they are beginning to think genuinely inflation will be here for longer. Indeed, it may be very well, but at the same time, the direction of the growth of inflation is on the way down, and that's where we see the opportunity remains in the equity market.
So as Anne-Marie pointed out, look out for you, Mitch, a little bit later for consumer inflation expectations. John, I want to look ahead to next week. A risk factor in the near term, and you can talk to me about how big a risk this is if that median dot in the Fed projections comes down from 3 to 2. Is that a big deal to you, given that this market has gone from 7 to 3 and equities are still close to all-time highs?
I don't think it's a really big deal. I think it's not just the Fed's heart is in the right place, but the general tone of Fed speak is very much aware of what is going on. It's into this idea, well, they won't say it, but it's going gently into that good night, in this case, in the sense that they are very sensitive to what is the essentially the mandate of the Fed, which is to produce an economy that grows at a sustainable pace without horrible inflation, with manageable rates of inflation. And then when it comes to employment, full employment as defined by somewhere between 3 and 4% unemployment. And it looks like they're doing the job. And I don't think Powell and his Fed want to have a legacy of either cutting too soon or staying at the higher levels where we are now relative to where we were before for too much longer. That said, we continue to think it's a second half of the year when we see the rate cuts happen, and we never expected the 5 to 7 that others were. We always thought it would be likely 1 to 2, perhaps 3, which is what the Fed had initially intimated towards the end of last year.
You've been outspoken about that, John. I just want to finish up by talking about sectors and what you like in the equity market. I know you like cyclicals over defensives. Now, traditionally, defensives would include things like healthcare. Now, healthcare has this GLP-1 element to it, which makes it almost offensive. It's where a lot of money is going in this bull market at the moment. John, what is defensive to you?
Defensive would be consumer staples, the Utes, a significant portion of healthcare outside the weight loss drugs and some of the offsets that come to that, or rather the additional things that come with that related to perhaps what can be done against heart attacks and things like that with the same drugs. But we can't help but think that you want to be in technology, consumer discretionary, industrials, financials, and we're gaining additional exposure to materials here, and it just looks like people are looking at the world and thinking China may be having real problems that it still has to address, but the rest of the world is in a process of normalization where we're in a better situation. We're leaving the emergency status of the world economy, and in that process, moving towards a more stable environment. Now, that doesn't mean anything can happen that would counter that, okay? So you have to be diversified, and you have to know what you own, why you own it, and have right-sized expectations. You can't get too gaga over the market here. You have to be, that's why our target, we're only 1% away from our year-end target now. And people were asking us through most of the first quarter, why don't you raise your target? Well, when we started out in December, we were indicating 13% upside. We just didn't realize how fast we were going to move.
John, to that point, are you going to upgrade your forecast?
We'll have to see. Lisa, I'm looking at all the stuff you're looking at, and John's looking at, and when I think of it, we've got to give it consideration. But I must say, from where we're sitting here today, it would seem like the likelihood of being forced to raise might be necessary after all these bears have suddenly gotten onto the bull case. But some of these guys are talking out of both sides of their mouth, stagflation. But
don't say.
Other people within their group saying, oh, it's going to go higher. I don't know. I try to avoid the noise, separate the signal from the noise.
Hey, John, appreciate your time. I think that was a diplomatic way of dancing around that question and answering yes, maybe, perhaps at some point in the next couple of days. Sarah Hunt of Alpine Saxon Woods writing this: there is a tension between the idea that not cutting rates means financial conditions will passively tighten if inflation continues to wend its way lower, and concerns that when there's enough liquidity, the conditions are still too loose. Sarah, I'm pleased to say, joins us now. Sarah, what do you think of that data? PPI, upside surprise, CPI, upside surprise. How does it change next week's Fed meeting?
It's going to be interesting because I agree with the guests that you've had on earlier and what you guys have been talking about. The Fed wants to cut, right? They're looking for an excuse to cut because they don't want to get to the point where they're passively tightening as opposed to, they don't want that to happen. But I think that this data does not give them any help in that. They could just sort of ignore it and say, well, yes, we're looking at other things, to your point, Anne-Marie, that, we're going to look for the PC, we're not using this. But I think that it makes it a little bit tougher for them to do it on the time frame that they were looking at. If this had been a more benign number, I think you would have seen that May call come back. And I don't think anyone was looking for anything in March. So they may just not say a whole lot about it, but we'll see. It's going to be interesting to see what they say.
Should jobless claims make them comfortable, or should retail sales make them uncomfortable?
Yes.
Yes to both?
Yes to both. And that's the problem, right? Because we keep getting these different pieces. The labor market has stayed stronger. In December when they pivoted, one of the things that Chair Powell said was, we now see the risks as being balanced between inflation and the labor market, whereas before that, everybody was like, they're going to try to kill the labor market. So I think that the fact that we are seeing still good labor, they really don't want to put the country into a bad labor market. They don't want to do that. So that's going to be helpful, but it's just, the other data was just not that great.
It strikes me in some of my conversations that just hypothetically, some people might be very bored with the muddle because it's been the muddle for quite a while. What does a bored trader do, given the fact that we've got a lot of them?
Well, they probably take out too many leveraged bets that come back to bite them. I don't know. This is the problem of having the non-directional. You were asking earlier on the FX trade, like someone's looking for a big directional trade. We have these little incremental moves where the moves are incremental, but the zeitgeist swings from, oh my God, we're going into a recession, to, oh, the economy is so great, we don't have to cut rates. There's been a lot of moving back and forth, but it's from the same two places. And that does tend to get people, you can't quite figure out what's going on. If people are not worried about rate cuts being pushed out because the economy is good, well, that's great for the market. If they're worried that they're getting pushed out because inflation is bad, that's bad for the market.
People are so spoiled. The fact that people are bored. We've just had an all-time high in Japan, haven't seen one since 1989. We've had records in Europe, records stateside. We've got two huge bull markets taking place, one in AI, another in GLP-1s. I understand that they want more. We always want more.
Okay.
But seriously, some of the levels we've hit in the last few months have been pretty incredible.
Yeah, but they haven't been a straight shot up. It's been basically and it hasn't been with any conviction.
In February alone,
yes,
we had two of the biggest single-day market cap gains on single names in the history of this stock market.
But has it been because people are just plowing in and just so excited and looking for that upside surprise, or is it because basically it's just been the story that keeps on giving? You've won by not shifting around your portfolio at all, which is hard to do.
That's why they're bored, because they're waiting for the rotation that hasn't developed in the way they wish it was. We caught up with CBOE Mandy Zhu earlier this week, and she said they're positioning upside bias, and we're like, on what? Small caps, right? They're bored because the same things keep winning. Should they start to get used to the same things winning all the time, or is that going to change sometime soon?
Well, there's also the issue of, the same things are winning, but that then echoes a lot of other market bubbles, and people start worrying about a market bubble too. So there's that problem as well. I think to the extent that the AI stocks are winning, they're really making money. There's actual cash flow there. This isn't a group of stocks that is running on a promise, right? It's running on some actual results. So there's that. So I think that stays sticky. But on the other side, there is some concern that you're seeing these big run-ups in things like the GLP, there's real money there. But then what happens to the rest of the market? And there's a lot of parts of the market that haven't been participating.
Including energy to some degree. And I know that you were bullish in energy and then you pulled back a bit. We're seeing this rally, though, that's pretty persistent. We're seeing oil prices at the highest levels going back to November, and this idea that maybe supply can't keep up finally with demand after a pretty strong run. Have you shifted your view on energy?
Well, to your point also earlier, there is still excess supply out there, right? Because there's still being oil held off the market. The question is, it's moved up, and it's moved up in a quiet way. So the stocks haven't really caught up. So there's value in that trade right now. The question becomes, does this problem that's going on with transportation, because it's still a problem, they're still seeing that issue going through, does that change? Because if it doesn't change, then you can see tighter markets, and you're seeing them right now. And that move up hasn't been a convulsive move up. It's been like that incremental, itsy bitsy spider move up. So
It's kind of crazy that we're all excited potentially about a Brent crude move in the 80s, and there is literally a hot war in the Middle East, and you have Houthis still striking vessels through the Red Sea and the Gulf of Aden. I mean, how high could you see oil prices actually go, though?
Well, I think, so right now you've seen the problem that's causing, which is higher transportation costs and longer transportation times. But it hasn't hit production. It hasn't hit something like right now that's staying within a framework that is not problematic for the fields themselves. It's problematic for transportation. If that changes, I think you could see bigger moves, because then you don't know where the supply is going to come from. Right now, supply is not so much the issue.
Sarah, we've got these two risk events on the calendar. The Federal Reserve in June, because that's when this rate cut's going to happen now. Most people agree. And then you've got this election in November. And people just sort of look at it at the calendar and say, it's out there somewhere. I don't need to think about it right now. Do they need to think about it right now?
I think the difficult thing is that there is such a long period of time, and that there's this expectation that any number of things could happen, and so that it's hard for anyone to pin it down, and that any changes either on the global stage or other places could shift things one way or the other. So deciding today what you think the outcome is going to be and acting on that is quite difficult. I think with the Fed, there is that expectation that we're going to get some rate cuts, but as those dialed back, it's not the same as saying, we were going to be down 200 basis points, right? And that was going to change everything, and that's okay, and that's great for tech stocks, and it's great for all sorts of things. But on the other hand, the fact that you're getting interest on cash is a good thing too. So where the Fed goes ultimately is going to be a big deal, and that keeps shifting around too. We keep hearing now north of 3.5%, maybe it's 4%. There's a lot of change that's been going on with both of those things. So it's hard to say, yes, let's make a plan, and let's make a plan on the basis of this X going this way.
Michael Shepard was just talking about how either way, whoever wins, there is going to be this emphasis on trying to protect the U.S. security, to protect U.S. workers from some of the international competition. Does that feature in what you decide to buy, what you think might be susceptible to national security claims and real kind of interference on that level?
I think that really shifted from the beginning of the pandemic even to now, because the move was, for whatever reasons you want to call it, was either home-shoring or on-shoring or friend-shoring, or however you want to, whatever terminology you want to use, that says, I need to make sure that I have a decent line of sight into my supply chain wherever it is, because we've had transportation issues before. We're now seeing this issue in the Red Sea. There's all sorts of things on the international stage, and or somebody who was an ally could become less of an ally, and then all of a sudden they're going to threaten not to give me the things that I need. So I think that was already happening, and I don't think that either side of the aisle right now is pushing in the opposite direction. So I think that directionally that's going to continue.
Has it happened? Because a lot of people say that it actually hasn't happened, and the whole nearshoring and friendshoring was sort of a lot of lip service that didn't really come to fruition. Do you buy this story that we're in the process that is going to be naturally inflationary, that's going to build in redundancies, that's going to have legs?
I think that it's not happening for a variety of reasons. There's a number of stories about the CHIPS Act, about why that money isn't going places, and there's too many regulations and restrictions on that. But I think from a standpoint of, I'm a corporate CEO, I want to make sure I know where my things are coming from. Is it going to be a chip plant in the U.S.? At some point, probably. But in the scheme of things, I'm going to be much more attuned to that than I was before, regardless of who ends up in the White House.
How does the U.S. talk about friend-shoring when they want to block a deal from a friendly ally?
That is a difficult question to answer, and I did not block that deal, so I cannot answer it.
Yeah, but how do you prepare for that? It's almost impossible.
I agree. It's such a good question. Sarah Hunt of Alpine, Saxon words. We've seen this repeatedly. We're dressing things up in language that might be palatable for our allies, but ultimately look at the action. Don't listen to the words. This is the difference between former president talks about America first, starts talking about America first. Everyone's like, whoa, America first. What's this about? Tariffs on China. How dare he? And then here we are. Same policies dressed up in very different language, but ultimately the same thing.
National security in the Wall Street Journal editorial review this morning calls it self-destruction. And they say regardless of Trump or Biden, it's going to be a nasty election, but there's going to be policy damage because of it.
It's the latest this morning. Treasury selling off after a hotter than expected inflation print, reinforcing bets that the Fed is in no rush to cut interest rates, while lower than expected retail sales, leaving Ian Lyngen of BMO saying this: the pace of retail sales during Q1 hints of the specter of stagflation, although it's only a couple of prints and insufficient to draw any broad-based conclusion. Ian Lyngen joins us now for more. Ian, let's get into this. Is that what we're starting to smell, the scent of stagflation this year?
I think that there's a non-zero probability that we find ourselves in an environment where demand continues to slow more and more. Certain aspects of inflation prove stickier than the Fed wants to see. And then the big question is, how does the Fed respond to that? What do they do? I think they've done a very good job of laying the groundwork to cut, not ease. And we're far enough into the cycle that they can justify that.
So if the dual mandate goes into conflict, you think they can still cut interest rates later this year?
Precisely.
Okay, so here's the question for the markets. The markets believes now that this Federal Reserve has established a more asymmetric approach to monetary policy, that if strong growth comes through, they don't have to hike, but if growth weakens, they can cut. Does it temper their ability to respond to adverse shocks if inflation remains sticky? You're saying they can still cut. I want to understand by how much. Are we talking about 1 or 2 versus, say, 5 plus?
You know, it's interesting because I think it really comes down to the composition of inflation and where the stickiness comes in. If it ends up being on the supercore measure, which is highly correlated with wages, that's a problem for the Fed. If it's housing, if it's OER, if it's rent, that's a residual from what happened a year and a half ago. And if that ends up being the case, then they can easily justify moving back closer to neutral if the situation warrants it. And what warrants it? It certainly isn't a flat GDP print. It would have to be well into negative territory.
Which raises this question, what is neutral? And I keep going to Elsa Linios and this idea that she was saying maybe neutral, in their view, is actually north of 4%. And that's what we're looking at, this sort of rolling ball of cash that's shifting into different areas and causing inflation to surge in different places that will keep inflationary pressures higher than they have been traditionally. Can you get on board with that?
I'm very much on board with the notion that neutral policy rates are a moving target, and it's not a single number that will hold indefinitely over time. I think that the Fed would probably agree that because of a lot of the dislocations that occurred during the pandemic, that our star was higher over the course of the last couple of years. The bigger question becomes, what is it like at the moment? Are we truly in restrictive territory? The combination of the balance sheet rundown and the fact that as year over year core inflation numbers start to decline, real policy rates will increase, really puts the Fed in a unique situation, and one that I certainly don't envy.
Well, what do you think? I mean, do you think that it's restrictive based on the evidence that inflation isn't really getting tamped down as much as people expect? And sure, we got one weaker than expected retail sales number, but you look at the earnings and companies are still doing all right.
So I would say that it was clearly restrictive during the second half of last year, which is why we saw the progress made on the inflation front. But the equity market doesn't believe that it's restrictive, and that's actually really problematic for the Fed since overall financial conditions are much easier than Powell would want them to be. And that feedback loop, to a large extent, is why I believe that there is some stickiness in the inflation complex at the moment.
I got 2 questions. You've kind of alluded to the fact that you think he cares about equity markets, but he barely talks about financial conditions. When we raise the fact that equities are close to all-time highs and credit spreads are super tight, get people come on this program and say that's not that important to Chairman Powell anymore. Why do you think it is important?
I think that he's very strategic in the way that he chooses to emphasize the relevance of financial conditions. When they were tighter at the end of last year, it was very important because it was consistent with the messaging that he was putting forward, which is we're nearing the point where we're going to start cutting rates. If the Fed starts to reintroduce the conversation about financial conditions, that's hawkish in this environment. It's not dovish, and that would suggest that while the market seems content to price in a June rate cut at this moment, maybe the real departure point for normalization is July or later.
$20 trillion call for you now, Treasury market. What do I do with the long end? You've told me what you think is going to happen with the Federal Reserve to some extent, what that could mean for the front end of the curve. What do I do with a 10-year? What does that look like in the world that we're starting to sense is developing in 2024?
So I would say that we are in a period where we might see upward pressure continue to develop in the longer end of the curve, but 10-year yields aren't going back to 5%, and eventually we will find ourselves in a situation where inflation does start to moderate, and that means break-evens will compress, and that means that 10-year yields above, let's call it, 435 or 450 start to look attractive, but we're not there yet.
Which is really the reason why I was going to Elsa Linios' call. And people might say, R-star, neutral rate, my eyes glaze over, I don't care. But the idea here is that if the overnight rate is more than 4%, it doesn't make sense for 10-year treasuries to be trading at 4.27% currently. They would be trading at a much higher rate. So at what point does this market sniff that out, since right now there is none of that being priced in?
I would say that logic holds very well for the 2-year sector, and the operative issue is whether or not the Fed ever chooses to review the 2% inflation target. Because even if R-star is higher, if the Fed is going to get us back to 2%, that just means they have to risk greater demand destruction to get us there. And so, like I said, I'm very, very on board with bearish in the front end of the curve. Really hard to justify 10-year yields at 5%, even if R-star is 100 basis points higher.
To put a bow on it, are you basically saying the biggest risk case for next week is for Fed Chair Jay Powell to come out and say, I care about equities?
I would say the biggest risk for next week is that we all look at the 2024 dot and it says 50, not 75 basis points worth of rate cuts, and that's what triggers a more dramatic bear steepening.
Andrew Honohorst, the City, just published on that. He said 75 basis points. The median dot will still imply 75 basis points. Can we have your base case? Is it 50 or 75 next week?
Base case is 50. Excuse me, base case is 75, but there is a real risk of 50.
Interesting. Ian, thank you, sir. Really thoughtful stuff. Ian Lyngen there of BMO.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.